start. Good evening, ladies and gentlemen. My name is Nicholas, and I'm Senior Account Manager in Ford Trade Brokerage Company. I will be your guide tonight through technical analysis lecturing that organized the Ford Trade Research Department and the Ford Trade Company as well. In the beginning, I would like to remind you on risks that are carried by with the CFD tradings. So the trading CFD and other leverage products carries a high level of risk to your capital as price may move rapidly against you. Be aware you can lose all but not more than the balance on your trading account. CFD may not be suitable for all clients, therefore ensure you understand the risks and seek independent advice. Those that are actually first time or in the beginning of their developing trading path, they have to get familiar with the fact that Ford Trade provides services to trade in the global financial market with the CFD instruments. There is a difference with the CFD products and the regular investment products. More information regarding that you can find on our website, and you can inform yourself also with your senior account manager. Today's topic is regarding the technical analysis, and I will try to present to you on as many as possible simple way, so you will be able to understand and to get the main points regarding the mostly used technical indicators. I will try to help you to understand those indicators, their meaning, and of course their implementation. During this webinar, during this lecturing, we'll speak about types of the markets. Then we will explain a few differences between some types of the technical indicators, and among them we will speak about moving averages, relative strength index, MACD, Bollinger Bands, and also we'll speak about combination of those indicators and how to implement the signals that we are getting from them. Basically, when we are speaking about technical analysis and technical indicators, we have to bear in mind that there are some assumptions that are actually giving the relevancy to the technical analysis. First of all, the technical analysis, the technical indicators are based on the historical price movement, and based on that we are trying to get the conclusion how the prices can move or should move in the near future, and to react upon that. First of all, what's very important in the technical analysis is a trend that is tried to be revealed by the technical analysis, and we can speak about three, let's say, different trends, and markets can went through these three different types of trends. First of all, we have rising trend, which is framed by two parallel rising lines here in the chart, you may see. This is actually the feature when every single bottom or ending of correction is higher and higher as the time passes. Also, the highs, the peaks in these waves are higher and higher, and this is the main feature of rising trend. The following type of trend is a sideways or a range bound trend, or we can also speak about range bound or sideways markets. Those are the instruments and the assets that have this feature, that the oscillation is going in one previously defined range where we can see the resistance and support line, and usually we say that in that moment the market is in consolidation, because the low and the lows and highs are, let's say, almost equal, like the previous one that we had in the near past. Also, we can recognize the downtrend, and also the markets that are in downtrend, that they are opposite from the rising trend, which means that the consecutive lows or consecutive highs are on the lower level than the previous one. Also, we can frame it with two different parallel lines, and we can use that as an option. This is let's say the simplest way, or the simplest lesson from the technical analysis. It has, first of all, the visual approach, and it's very easy to recognize on the chart the patterns where we can draw the lines and say that current trend is a rising trend, sideways or downtrend, and we can adjust our trading and training strategy to the current market condition. What is very important, that nothing in the technical analysis is definite. You should not blame the technical indicator or the features of the technical analysis if the trade went to the stop loss or went against you, because market is changing. We are using the technical analysis, the lines and indicators, just to try to predict the future movement. Doesn't mean that market cannot go in the opposite direction. First of all, because market is a live thing. Second, we are using, as we said, indicators that are based on history, on the previous trading, and there might be the events that can change the trend. Something like a speech of someone, some official that is important for the market, or some strong macroeconomical data that are released, or something like that. So those things might change the trend. What is very important when you are making a trading strategy with those lines, it's important to understand the concept of support and resistance line. Those lines are actually presenting the lowest price that is actual for some longer period, and resistance line is the highest price that is represented, that presents actually the highest price in some previous period. And upon that, you can set up your trades. When price approach the support line, you can consider to enter in the buy position, place the stop loss order few pips below support line to secure yourself, and to target put the target towards resistance line, and vice versa. We said that this is the simplest way how to approach to the technical analysis, and also these lines that we are using in the trends, and also when we are trying to determine the sideways trend, we can use combining with other technical indicators. Before that, I would like to make a short digression. Usually, technical indicators are divided into two main groups. Indicators that are showing trend, which are called trend indicators, and indicators that are showing the saturation of the trend, or trading impulse, that are called oscillators. There are many other technical indicators that are also in use, but they cannot be classified in these two groups, and they are let's say in the third group named common. One of the most interesting, most attractive, commonly used indicator of the trend is moving average. Moving average present an average in some certain period in the past. For example, we can use moving average for 10, 20, 50 periods. This means that this indicator will show the mean of sample that includes previous 10 periods, previous 20 periods, or previous 50 periods, no matter what we choose. When the next period appear, it will take in its sample, it will take the following period and will exclude the oldest period from the history, and that's why it's called moving average. It's moving all the time towards the latest information. Now, when we're speaking about moving averages, we can speak about moving averages on the different time frames, and also we can speak about different types of moving averages. Different time frames are just showing that this period can be related to time frame of the chart. For example, if we are using the 30 minutes chart, moving average of 10 period will take in consideration 10 periods, each period by 30 minutes, which means that in totally it will take the price oscillation within last 5 hours. If we are taking, for example, moving average 10 on a daily chart, it means that this calculation will take in consideration last 10 days, etc., etc. So you can choose the different options with the time frames and the different options with the periods, what would you like to see. Also, we can discuss about different types of moving averages. Most commonly used moving average is simple moving average, which is applied on closing price. When you are looking at the period on the chart, you see the candlestick. You know that the candlestick is formed by four elements: the highest price, the lowest price, opening and closing price. Usually, simple moving averages is taking the closing price in consideration, and it's calculating its value. And it's simple because every single data in this calculation has the equal importance here. So each period in the history is, let's say, equalized with its influence on the final result. This is not the case with exponential moving average, which is trying to give more importance to the recent results. And just because of that, the exponential moving averages is faster with adjustment to the movement into in the last history. When we are comparing those two indicators, we can also say that exponential moving average is a faster one. It's adjusting on the faster one, let's say on the faster pace to the current movement, and this is something which is trying to overcome the disadvantage or the malware of the simple moving average, because it's giving more importance to most recent data. Okay, for example, it's very important when you are using the moving averages, and when some important report that should be released, macroeconomic report that should be released, is approaching, then markets start to volatile, instruments are getting more liquidity, range of the fluctuation is higher, and then you need a time over those periods to take in account these changes that are happening due to this report that is released. Exponential moving average is something which is adjusting on the faster way, and based on that, it's actually trying to give a better signal and a better picture. Also, the combination of simple moving average and exponential moving average is something that is very well used in the trading, and We will speak about it also during the today's lecturing, because all this adjustment to the market is very important to see how they are how they behave to the history. Also, the combination of different moving averages, slow and fast moving averages that have that include shorter and longer period in consideration, can help in the trading. And based on that, we have different trading strategies or trading methods that are based on moving averages. For example, it's commonly used a combination of some moving averages in the trading, which will also be elaborate during today's lecturing. But for example, we can choose the slower moving average, which show the history and averages for the longer period, and to apply additional faster moving average that take in consideration shorter periods. For example, we can combine moving averages of 10 period and 50 period, and we can follow up the trend by slower moving average, the moving average in 50 period, and to take signals for trading based on faster moving average, the faster average on the moving average on the 10 periods. The way how to trade with the moving averages is something which is let's say individually considered, because you have many different approaches, many different styles, depends on the preference of the trader. For example, you can choose to trade based on price crossover. You can choose to trade based on moving average crossover. Depends which kind of signal would you like to get. Usually, the traders that would like to get faster signal, they will use price crossover. This means that they will trade each time when price crosses moving average in one direction, or when the candles are moving through the moving average and change their direction. This is, let's say, a very fast signal or pre-signal. Sometimes it can be the leading indicator for future trend change, and this can provide huge success to the traders that are following up the trend and the potential trend changes, because they will be able to catch significant price range when the trend changes. For example, we can see a price cross in left hand side. In the bottom part of this chart, we see where this very tall candlestick broke the moving average. Immediately, this red line, which presents fast moving average, changed the slope from negative to the positive, and this is called price crossover. This can be a moment where traders can take a chance and open the buy position, because see, the moving average changed slope, then slope is positive, which means that the trend is uptrend, and you should consider to enter in buy position. Considering alternative scenario and take profit is also very discussable. It also depends on the preferences of the trader. Someone can take fixed price difference as its take profit. For example, each trade you can choose to realize with 20 pips of profit, or $50 of profit, or whichever price difference you choose. Also, you can choose to close your position first time when price make a correction, and when it touches the same moving average line and cross moving average line. Also, you have many different ways how to set up a stop loss and take profit order. everything depends on your risk management and your risk appetites. Um, the same thing is with the following slowing moving average. You can decide which type of the moving average would you like to use, and also the difference between crossover and moving averages. Crossover is that moving averages crossover gives you more clear signal that eventual consolidation or some kind of speculation or monetization passed, and you have, let's say, the higher probability that taking chance with this signal is much better for you, and probability that you will realize your position with a take profit is a little bit higher than if you're choosing to place an order just based on price cross price crossover. Now we'll see a couple of examples. Here we see the difference of the moving average, the simple moving average and exponential moving average. You see that this blue line, which is adjusting on with the faster pace, this is presented by the exponential moving average, and simple moving averages with the red line that has, let's say, more smooth slope, so it doesn't adjust so fast to the market and the market prices as exponential moving average does. The same way how you can trade on the price crossover or moving average crossover could be applied both on simple moving average and exponential moving average. Usually traders are trying to find reversals. Now, when we are speaking about reversals, we are speaking about trend change, but also the same trend can be tested many times, and each test can be a signal for entering in position. Besides the signal, the moving average also can act like a strong support line in a rising trend or a resistant line in a downtrend, which means that also this line can be used as stop loss line. In this case, we present here two situations where we can use the crossover. Okay, it is highlighted with the ellipse in the chart. You see, when price is breaching the moving average and in the positive slope, this can be a signal for entering in position. Okay, which is also written in the slide. Price crossing above moving average indicates a bullish breakout ahead. The same thing in opposite direction can be considered as a bearish breakout. So when price is crossing below the moving average, indicates bearish breakout. Okay. Disadvantage of this kind of signal for trading is the situation where the price is just behaving like in a choppy trading, you see, and going in a few candles going in the opposite direction, then change fast, etc., etc. In this way, traders can trade a couple of times while they get clear signal that can bring them very good profit. This method of trading, price crossover, means that if you respect the methodology and if you enter in the trading on each signal that you find in the chart, that means that you will trade more actively, you will place a lot of orders, but your success rate might be lower than 50%, but average profit should be multiply higher than average loss in this case. Now we can speak about moving average crossover. Let's say the concept is the same, but just we need a small confirmation just to avoid the disadvantage of the price crossover method for trading, as we stated previously. So to avoid the situation when we can enter many times in the position and to close our position with a stop loss, we can choose to determine our trading signal by moving average crossover. For example, if we combine slow and fast moving average, the place where we have intersection of two moving averages are showing us the signal for trading. Whether both of them have a negative slope, this is a signal for bearish reversal, and thus it is a moment for entering in a sell position. Or if both of them have a positive slope, this is a signal of bullish reversal and possible moment for entering in the buy position. Now, all of these things are also written in the slide. So let's define it on the book's way. Short-term moving average crossing below long-term moving average, which means that fast moving average with smaller amount of periods, crossing below long-term moving average is often the sign of bearish reversal. Or when short-term moving average crossover above a long-term moving average, often the sign of bullish reversal. Okay, I hope that this is clear and also visually understandable. Now let's go further. I will explain you also the one of the indicators that is from the other group. We said that moving average is from a group of trend indicators. Now I'll speak about relative strength index. Relative strength index is from a group of oscillator indicators, and it shows the relative strength of the trend. Okay, this means that in the same time, this indicator can show saturation of the trend. I will not bother you with too many calculations and formulas how you can get this index by calculating the prices, including all the things in the formula, because it's unnecessary. You have it already in our platform. You just can apply it to the chart, and you can see the additional chart which presents the relative strength index. As its name says, it's relative, which means that it has limited range of values. In this case, it can move from 0 to the 100. Rarely it's on 0 and rarely it's on 100. And also key values in this case are set on 30 and 70. Usually when relative strength index, or shorter called RSI, is below 30, this means that actual downtrend is about to finish. This means that price already fell down in the zone of oversold. Okay, and potential reversal might come in the future period, in the near future. Same thing can happen when relative strength index passes over 70 of its value. This means that current trend is already in the overbought zone, and that potentially trend change or a reversal might come. Now, it doesn't mean that immediately when relative strength index passes through the 70, that actual trend will be finished. Now, this just means that actual trend is very strong, that potential further upside is limited, not that it is over. And when it starts to lose its power, or when relative strength index starts to lose its value, it can be a time to realize previously open buy position and to consider potentially entering in a sell position. Now, it's very hard to speak about relative strength index only for itself. It has to be combined with some other indicator or with some other signal, for example, with the lines or with moving average. Because if we have a very strong uptrend, rising trend, usually relative strength index will show that price is in overbought zone. And every correction that comes and tests the support line, of the rising trend, might mean that just correction is about to finish, and again trend can continue. But it doesn't mean that relative strength index in the same time will fall to the oversold zone. So that's why we have to combine different trading indicators and different technical indicators to get better and clear picture. Now, the signals of saturation of the trend are also highlighted here with orange rectangles. So all the time when relative strength index is below 30 and make like a convex cap to characterize the current moment on the market, we can say that market is in oversold zone, previous downtrend can be finished, and potentially reversal can appear, or the uptrend can appear. And usually we can enter in the buy position when relative strength and relative strength index finish its being in the oversold zone, crosses over 30 and continue to go towards 50 or 70 or the higher prices. So when it finishes its being in the oversold zone, this might be a signal for entering in buy position or to hold the long position. The same thing is with action in the overbought zone. So we are not just finding a situation every time when relative strength index steps in the overbought zone. We are trying to find a moment where the value of the index start to weaken and to go back down below 70 towards 50 and finally to the 30, and then we are entering in sell position and trying to make price difference in that way. As I said, we can combine relative strength index with lines. There is several different methods that we can use in our trading strategy. One of those methods is called divergence, bearish divergence and bullish divergence, which actually shows the different slope of general trend in chart and trend of relative strength index. In this case, the bearish divergence appears when price makes a new high, but the RSI does not make a new high. So you see the line that is capping the highest values of relative strength index has a negative slope, while at the same time line that is that makes caps on the highs of the chart have a positive slope. So this situation is called bearish divergence. In the very same moment, it can be a signal for entering in a sell position. On the other side, in the opposite, when the line that is actually connecting the lows on the relative strength index has a positive slope, or at least neutral, zero slope, and at the same time the line that is connecting the lows on the chart has a negative slope, this is bullish divergence, and potentially can be used as a buy signal. Going forward, we'll discuss a little bit about another one, oscillator called MACD. Actually, the MACD is a short gauge for moving averages convergence divergence, which is actually presented also in additional chart like relative strength index, and it consists from bars, vertical bars, and signal line. Vertical bars actually present the difference, the absolute difference between moving averages that can be applied on the chart. Usually, those moving averages have a value of 26 and 12 periods, and we're speaking about exponential moving averages, and we have additional signal line of 9 periods. So when we see that bars gaining its value under the zero, this means that the actual trend is downtrend. When it starts, these bars, when they start to be narrow and they're transferring from below zero to above zero, the positive side, this is a sign for entering in a buy position. Also, it's the same like moving average crossover, but here we can use also the signal line, which is following up this histogram that is in additional to the absolute chart. Now you see the similarity between all these indicators. We said moving average is a trend indicator, and in this case moving average convergence divergence, or shortened MACD, is oscillator indicator, and it shows also the way where the trend is saturated and potentially can be finished. When you see the dynamic of the histogram, actually when you see that the bars, the value of the bar is going all the time higher and higher, you know that the trend is very strong. When you see that consecutive bars are about with the same value, or the following bar has a lower value than the previous one, it means that divergence is becoming a convergence. So the lines of the moving averages start to approach one to each other, and this means that the trend is start to losing its pace, and it's time to get out from position that you previously opened. Also, it's very good to use for the trading in consecutive way. So all the time when you see that signal line enters in a zone of histogram, you can consider to enter in a position. If it is with a negative slope and below zero, this is a sign for sell position, or it is in positive zone with a positive slope above zero, this is a signal for buy position. Following that, when the signal line exits from histogram zone, this is something that should be considered as a signal for closing of position. Let's call it the disadvantage of this indicator is that it doesn't give you idea where to put a stop loss, so you should consider your alternative scenario as some kind of fixed amount of pips that you are using in your risk management. As in the case of the relative strength index, also we can find a way here to use divergence. The same way as we discussed about bullish and bearish divergence, we can also find it here. Just we are trying to face one to each other the different concepts. Here in the MACD, we are trying to connect lows, while at the same time in the original chart we are connecting highs. If those two lines have a different slope, that means that we have divergence. If we have positive slope with the MACD and negative slope with the original chart, this is bullish divergence. And if it is opposite, if we have the negative slope while we are connecting highs on the MACD and lows on the original chart with a positive slope on the original chart, it means that we have bullish divergence and potentially we can enter in a sell position. And last indicator that we will present this afternoon is Bollinger Bands. This indicator is also from the group of trend indicators. It's very common used, also very popular. It's innovated by John Bollinger in the middle of 80s. It consists of the moving average line of 20 periods, which is followed by two additional lines that are showing the standard deviation from the moving average. Actually, both of those lines represent distance of two standard deviation from the moving average, simple moving average line. In this case, this middle line that is actually presenting the moving average line, simple moving average line, 20 periods, the methodology of calculation is a little bit different. So if you are applying the simple moving average or the close price, applying on the close price, you will see the slight difference. But the difference is just in a way of calculating the average. It's not something which will make so strong difference when we are speaking about its value of itself. What is very important here is that this indicator is trying to show us two different things that are actually separately presented by previous indicators. It's trying to show us the trend, and also in some periods it's trying to show us the saturation of the trend. These lines that are plotting the middle line also is trying to show us some kind of dynamic zone of oversold or overbought, where the trend is about to be changed. Now, when we are speaking about the trend, of course, like in the case of the moving average, if the middle line has a positive slope, we are speaking about uptrend, and we are trying to find a moment for entering in a buy position. And if the slope is negative, we are speaking about downtrend, and we are seeking a moment for entering in a sell position. Different methodologies for entering in position is also applied here, like in the case of moving average. It can be price crossover. We can also apply additional moving average. We can use price crossover with the middle line. We can use price crossover with the upper or lower line. So everything is actually individual, depends on how strong signal we are trying to find. In the case when we are using price crossover with the middle line, we have to be conscious that very fast we can find the reversal, and if we are using the tight stop loss, our position can be closed. Usually the traders are seeking the price crossover with the upper line if we are seeking for buy signal. In that case, when the price is crossing over with the upper Bollinger line and closes, the candle above Bollinger line, this can be a signal for entering in a buy position. All the time, the alternative scenario can be followed by putting the stop loss on the value of the middle Bollinger line. This can be combined on many different ways. As we spoke, you can choose some fixed amount of pips. Also, you can follow up all the time your tradings and choose to close your position when we see the first negative candle that is closing below the upper Bollinger line, and this will actually comply with moment where relative strength index is starting to fall below 70, for example, because we are speaking about dynamic zone of overbought in this case, or oversold if we're speaking about downtrend and closing below the lower Bollinger line. Let's say the last but not least, we can use all these trading indicators in one chart and trying to make a clear signal for trading. Each of these trading indicators are supposed to help us to find the best place where we can place our order. But you should bear in mind that if you are using too much of trading indicators, you can fall to the trap that from the wood you cannot see the forest. Because all of these technical indicators are actually based on different methodologies, different approaches, and they can give you a different picture. They don't have to comply with the analyzed periods. They don't have to comply with the fast adjustment to the market, etc., etc. For example, if we are using altogether Bollinger Band, MACD, RSI, and moving averages, and we say that we can use the crossover as a signal for trading, we just can see for the confirmation in MACD or in RSI, or in both of them. RSI is just showing us the strength of the current trend. Also, the exit moment, we can for the exit moment, we can follow up the MACD when the signal line goes out of the histogram zone, and that could be very good moment for a closing of previous open position. Never mind if we are speaking about sell or buy. We can see that the moment when the signal line of the MACD start to go out from the histogram zone, it is the very same moment when the price start to cross over the in this case faster moving average. In that moment, the value of the average start to change because price is not going in the same direction anymore, and the divergence is becoming convergence, and these two moving averages start to approach one to each other and to give signal that previous trend is about to be finished and that we can see correction or consolidation in near future. That would be all for tonight. I hope that this was a helpful lecturing for those that are trying to find out the best way how to participate on the market and how to decide whether they will enter in the buy or sell a position if they are not using analysis prepared by Trade Research Department or analysis of someone else. I will allow some short period for the questions. If there is questions regarding this topic. Also, I would like to remind you that you can consult your senior account manager regarding those topics. You can climb the record video of this lecturing, and also you can ask your senior account manager to help you with installing of the indicators and trading and reading with them. If there is no questions regarding this topic, I would like to wish you successful trading, lovely evening, and also very profitable cooperation for trade. All the best. Have a good night.